Welcome, everybody, to the FMI podcast. We seem to switch it up all the time. We're going to switch it up today. As most of you know, FMI is affiliated with an accounting firm called bookkeeper.com. And we have with us today Wes Kirtz, who's the managing director of the accounting practice. So welcome, Wes. We're just talking about how long have you been with the firm?
Almost 2 decades, so I think it's about 18 years.
Oh, you're not much older than that.
Yeah, well, the hair says otherwise. So,
well, welcome to the podcast, and just want to illuminate the value that you bring to our clients and to the firm, and then the value of the synergy that FMI and bookkeeper.com have. And so just to kind of talk about some examples of that. One that I've witnessed for a number of years, all the way back since the beginning of us doing this, is the ability to make life a little more simple for our clients and the general public. But when you're working on a client's tax return, for instance, and you see multiple sources of income from dividends, interest, and capital gains, what does that clue you in for?
sure, good question. So, I think, honestly, that's probably one of our most unfair advantages here is that we have financial advisors and CPAs working together, and that's usually not the case. And so a lot of times when I see a lot of different accounts from different locations, different brokerage firms, things like that, it kind of clues me in that there's probably some chaos there and there's probably some missing information as well. Having all those accounts, trying to do a tax return and just knowing that they've got so many different accounts, I know we're going to miss something. And so what that normally triggers for us is a conversation with a client that's really just to talk about consolidation. So I just had a tax discovery call last week, and the guy, very successful, very savvy investor, and what he did was he kind of took the diversification. I know we preach diversification and asset allocation to your clients, but he kind of took that to an extreme, and he had not just different locations like Merrill and Wells Fargo and LPL and things like that, but he also had multiple financial advisors, and his take on that was, I'm diversifying. I don't want all my eggs in one basket, and I don't want all my eggs with one advisor, which I completely understand. However, it isn't exactly the best tax strategy. It's not the best legacy strategy. And so while well-meaning, by the time we got to the end of that tax planning call, I said, all right, so is this advisor over here at this brokerage firm, it sounds like that's the one that you talk to the most. Do they have the whole picture, the whole plan? And he was like, oh, no, they just manage that money. And so I was like, okay, so what I am getting is that you really have no quarterback. You have nobody that has your best interest and nobody that has the holistic view of your financial plan. And so, fast forward a little bit, we're consolidating assets. We're consolidating down to one financial advisor, and we're able to work with you and our team to really have the best interest for the client, to consolidate everything so tax time's not a mess, there's no surprises. And there's a lot of other reasons to do that as well. If they've got, if they're over 73, they have to take required minimum distributions, then they'll probably, if there's 8 or 9 different IRAs in different locations, they're going to miss the required minimum distribution. They're not going to calculate it correctly. We're going to miss one. And so there's just a lot of benefit to consolidating it all into one house. You can have multiple accounts. There's plenty of diversification opportunity there, But I mean, you could even speak on, I can speak on the tax part of it. You could speak on the
Yeah,
diversification.
so the diversity, we like to say we diversify here. So if a client comes to us, we love diversification because it minimizes risk. But we can diversify within one account or a few different accounts. But your point about the quarterback is having somebody to oversee everything. So if if you have multiple, say, 8 different advisors, well, you may not be diversified at all. They may all own the same thing, and so in fact, you're not diversified because nobody sees that overall picture. So we do think that we bring value and cost savings and simplification of life by being able to consolidate it all within one group. One of the things that you mentioned and alluded to, and I know it's a big value add for what you do. But when somebody comes to us and has their tax return done, that's recording history. We're doing last year's work, and it's too late to do any tax planning. And I know that you do a lot of tax planning. What does that mean for the client?
Sure. Good question. It's kind of my whole thesis. My whole reason for being here is helping to minimize the tax burden for our clients. And um, so what we do a lot on at bookkeeper.com is we stress the importance of planning throughout the year. A lot of people come in April, get their tax return done, and they're like, what can I do? And 95% of the tax strategies that you could have done are out the window. So you've got to do that during the year. And so we plan, especially it's mid-year now, we're planning for the second half of the year, we're projecting out income, and we are employing strategies that couldn't be done after December 31st. And so we help save thousands of dollars for a lot of our clients, just even with one conversation at the end of the, or at the third quarter, beginning of the fourth quarter. And then the client just knows where they stand. And then there's no surprises. In April, they can plan for things. There's just a lot of opportunity out there that we were able to capture.
Taxes are ever changing.
They are.
Somebody said sometime, a brain surgeon, they're the smartest people on the planet. And like, well, the brain hasn't changed in 5,000 years, but the tax code changes every year. So I'm not sure, who's ahead there. But it is helpful to have for taxpayers to employ some professional that has to keep up with tax law changes. So the OBBA last year brought a lot of change. One of the things because we're a faith-based organization, many of our clients are. A lot of our clients are charitably inclined. So in 2017, the standard deduction went way up, and so 90% of people can't itemize anymore. But starting in 2026, I think we can deduct charitable contributions this year.
That's correct, with limitations. So they've done a few things in 2026. One, as far as charitable contributions, one not so good, and then they gave us a win here. But I'm going to start with the bad. So what they did when they increased the standard deduction, they effectively doubled it with the Tax Cuts and Jobs Act, which was very helpful. And that did knock most people out of being able to itemize. So when they're writing a check to their church or their college, they're really not getting a tax benefit from it. It's the right thing to do, but they don't really get a tax benefit. And so I'll start with the bad. And what they did this year, if you are able to itemize, most people are familiar with the floor for medical deductions, and so they they have a floor of 7.5%. So don't do math in public. But if you're $100,000 adjusted gross income, you can't deduct the first $7,500 of medical expenses. So I think they like that, and that discourages high medical bills and things like that. So they kind of did that with charity this year, and there's a new 0.5% floor. And so same math, you can't deduct the first $500 of charitable contributions. And so while Congress is sipping their coffee and eating their scones, they decided to give us a win. And even if you, new in 2026, even if you take the standard deduction, you can now deduct a limited amount of charitable contributions on top of that. It's called an above-the-line deduction. And so what it is it's for single taxpayers, it's up to $1,000 that they can deduct, and then married filing jointly is up to $2,000. And there's some limitations to that.
Of course.
Yes, and so it's only cash deductions. And so your Goodwill and Salvation Army and non-cash donations do not count. It has to be to a public charity, so your donor-advised funds and private foundations don't count. So there's limitations there and phase-outs and things like that, but we'll take the win where we can get it.
Sure. Yeah, like I said, I love to talk about charitable giving and using tax strategies for that. Most people, as they get older, they become aware of the required minimum distribution rules, RMDs. Now it's starting at age 73. You have to take out a certain amount out of your IRA and pay tax, or 401k and pay tax. But age 70 and a half is what the old RMD rule is. But they gave us a win many years ago that that you can gift money right out of your IRA or something. How's that work?
Yep, absolutely. So what you can do once you're age 70 and a half, you can do what's called a qualified charitable distribution. So you can take money directly from your IRA and give it to a charity. And so that helps, especially with the increased standard deduction, and a lot of people can't itemize. Now they get a full dollar for dollar reduction by giving money from their IRA directly to the charity. It effectively doesn't hit their tax return. It lowers their adjusted gross income, and once you're 70 and a half and you're taking Social Security, it's lowering your adjusted gross income is imperative. And so lowering that affects the taxability of Social Security, a Medicare surcharge, net investment income tax. There's just a lot of the bad things come out in the tax code when your adjusted gross income increases. And so having that option is a huge win. Do you do a lot of those for your clients?
Yes, we do a lot of them. We clear securities through LPL Financial, and so if they have an IRA and they want to, so we tell people generally if you have investments, you probably shouldn't be writing a check to your church to pay your tithes. There's other tax advantages to doing it. So for instance, if you're 70 and a half, we can do a QCD. We can have LPL write a check to your church or other nonprofit organization directly. And that obviously you're satisfying your giving desires, but you're also having the tax benefit of that. And in 2026, I'm really excited because the 1099-R, which reports distributions from IRAs and 401ks, previously did not have a provision for QCDs. Mm-hmm. And so it was this kind of reporting nightmare, and the IRS would, question that. But now there's a provision for that on the 1099-R, so hopefully it'll minimize those discrepancies there.
Yep, huge win for CPAs everywhere.
Yeah. I know everybody's always looking for the silver bullet. How can I save money on taxes? And, with particularly the 2017 Tax Act, it really took a lot of that away from us. But there still are ways of saving, but they have to be done in the current year. You can't, as you said earlier, you can't wait until after the end of the year to do these things. What I tell people is your best tax deduction is funding a retirement account. Mm-hmm. And I think you agree with that. And so what is it that what kind of advice do you give business owners or non-business owner taxpayers about funding retirement accounts?
Sure. So it's really one of the only, if not the only, ways that you can pay yourself during the year. You fund your retirement account and you get a deduction for it, and then it doesn't count as income. And you get to grow that money in a retirement account. And so you'll pay tax on it when you retire, but you most likely are in a lower tax bracket. And so it's just a huge win overall. I think this is where communication between your advisor and your CPA are pretty imperative, especially if you have a small business. Usually you start out and your advisor sets up a SEP IRA or a simple or something, and it works great, and then usually just ends there, and nothing ever comes of it. Nothing ever happens. They're just funding that. Well, the CPA knows your business profit, your owner compensation, and your cash flow and things like that. And if they're not talking to your advisor, you're just leaving thousands of dollars on the table every year. And so as your profit grows, you can do a like solo 401k, you can do a safe harbor 401k, or if it's growing even higher than that, you can do a cash balance plan. And all of that would have been or is foregone when your advisor and your CPA aren't talking. So again, the unfair advantage that we have here, but it's a very powerful deduction, and most people think of just saving $8,000 a year for a traditional IRA or something like that, but there's $70,000 and then a couple $100,000 depending on the plan that you can deduct this year for your business and save for your retirement and your wealth.
Yeah, we love it. I always say, people say, how can I pay less tax? Well, make less money, and then you don't have to pay tax.
Yeah, easy.
Or you give it all away, either in the form of a business expense or charitable contribution. But the retirement account is special because you get to keep the money and you get the tax deduction. It's the most powerful tax planning tool there is.
It's really great.
Yeah.
And then back on the consolidating all of that, I'm just thinking about, we just talked about the wealth transfer. By not consolidating, and this just popped into my head because I had a conversation this week with a client. Their parents passed away, and what my client is the executor, has a few siblings, and she is just like in tears because their parents had stuff. They're very savvy investors, but had stuff everywhere. And she's afraid she's going to miss something, and she's not going to account for things. And there was never a quarterback for her and for their estate plan. So the wealth transfer part of it has become a nightmare and a headache. And so if you don't have an advisor that's really quarterbacking everything and really administering the estate plan, trusts, and all of that, it can either be incredibly simple for your legacy wealth transfer, or it can be difficult, which is painful to see. We help a lot of clients through that that come to us after their parents pass away. So another reason to consolidate. Well,
this topic can be very, very deep, and we could go on for hours, but this is a nice touch into that, and I hope everybody can appreciate the value of having tax advisors and financial advisors in one organization to where we can see everything and we can be proactive. We can do tax planning ahead of time, not after the fact, and I think it's a special chemistry and synergy that we have here at FMI. So appreciate you joining us today.
Sure,
and
absolutely.
Maybe we'll do it again.
Let's do it.
All right. Thanks, everybody.
The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. There is no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to affect some of the strategies. Investing involves risks, including possible loss of principal. Individual tax and legal matters should be discussed with your tax or legal professional. Wes Kirtz and Bookkeeper.com are not affiliated with or endorsed by LPL Financial or Financial Management, Inc. Securities and advisory services offered through LPL Financial a registered investment advisor. Member FINRA, SIPC.